The charm of Mr. Youngkin is that he looks at this from an engineering standpoint, the mechanical engineer from Rice University. How are you going to engineer Carlyle forward, given a low-rate environment, low internal rates of return, and a lot of wall of money competition out there?
Well, I think like every good engineer, you've got to do the work. And I think in this environment, you have to do the work. Prices are high, and we think because interest rates are going to stay low and growth is going to be steady but low, prices are going to continue to stay high. So the key is when we find something to invest in, a real estate project or an infrastructure project or a company to invest in, we have to do the work, which means we better have a great value creation plan, because with asset prices high, you better create some value. And that's really at the core of everything we do.
Really, really tough right now. If you're looking at your opportunity set and you can see valuations are high, you think they're going to stay there, does it make it harder to get in?
Well, most of the time you're going to pay the highest price to get in, which means you better have conviction, and that conviction gets built around the quality of the teams. So we're blessed, I will say. Carlyle, 33 years of building great talent and great teams, and so we have specialized teams, lots of folks in the background who help create value, and when we see something that we think we can make a real difference with, then we go for it.
So I spoke to Mr. Rubenstein a little bit earlier, and I said, it feels like it's easy to raise capital right now, raise cash, and he said, I guess the people raising it probably won't agree with you, but certainly that seems to be the story at the moment. What's your message to people who have raised that capital then? Because you're saying there isn't going to be this big entry point that's going to open up anytime soon. What should they do?
Well, I think one of the primary reasons why there has been a strong flow of capital into private capital has been the returns. And the returns are expected to continue to be strong, premiums to what people can get over long periods of time in other asset classes. And so when we talk to folks, what we say is we're going to do our jobs, we're going to focus on creating value, and we expect the returns to continue to be premium returns.
Let's go Matthew right now. FV equals PV 1 plus R to the T. Okay, what's important here is IRR is coming down.
I'm not going to pretend I've followed that.
Okay, we're going to look at the partial differential, the time function, because he's going to go to logs right now.
Yes.
You're going to go to logs. What does your duration of hold do? Given lower IRR, what does your duration do given the wall of money John just described? Do you go from a 5-7-year hold out to a 12 or 20-year sovereign wealth hold?
Well, the good thing is we can do either. And I think the flexibility of the capital that's been raised today gives us the flexibility to hold for 5 years or hold longer if we need to.
Well, cut to the chase. What are you doing now? Are you guys becoming more sovereign wealth fund-like because of the deck of cards David Rubenstein handed you?
Well, the sovereign wealth funds can hold forever, so we still are going to exit eventually. But we are holding longer. And I do think that one of the keys to holding longer is creating value on a compounded basis for a longer period of time. We're not quick flip artists, and that's the key. You can't buy low and sell high. What you have to do is have a fundamental view of what you can do with a project or a company, and then it does sometimes take 5, 7, 8 years to get done.
Do you have to go up the risk curve?
I will say that to get the same returns that we used to get, you have to go up the risk curve. And I think the reality is in today's world, returns are coming down. And where we used to underwrite things in excess of 20% returns, we're underwriting them in the high teens today for the same risk profile. And that's just the reality of the market today. That's still a fabulous return relative to other asset classes.
But what you just said was maintain the risk profile, assume a lower return. I'm asking whether you're taking more risk. Are you taking more risk?
Yeah, I think in the grand scheme of investing today, because we're being much more active with the companies, there's a modicum more of risk. Now, how do you counterbalance that? With real talent, with value creation teams, things that you can control as opposed to leaving it to someone else to control. And that's how we try to manage that risk.
How do you perceive the wall of cash that your somewhat competitors, those that desire to play the Carlyle game, someone like Apple, well, Mr. Buffett's got a wall of money with him as well, but the technology people who have been advantaged by the boom of the last 10 or even 15 years, how do they play in your space? They want to. How do they affect that?
Well, I don't think they're going to compete directly. I think one of the great benefits of the wall of cash that's been accumulated in many, many companies is the fact that the U.S. has become a net saver as opposed to a net investor. And what that means is interest rates are going to have long-term a lot of pressure to stay low because that capital is going to find a place to have a home, which will keep long-term rates low. But when it comes to the kind of investing we do, we oftentimes find those kinds of investors to be good partners for us.
Compare what you and Mr. Buffett do, and that the standard Buffett procedure is interest, ownership, substantial preferred yield coming in 7, 8, 9% or well. Is that the Carlyle way, or do you have a different structure than we perceive Mr. Buffett has?
Yeah, a different kind of model. So we'll see a business or a project that we have a particular expertise in, and we believe that that business is good, but could become great.
You're not going to take the preferred yield coming in.
And we're going to own most of the time the equity. And then we're going to work with the management team, and we're going to do everything we can to try to grow and improve that business. We also take on some really interesting projects. So right now, we're in fact redeveloping JFK's international terminals. Now that's an important project.
Everyone listening to this is now very, very happy. Continue.
Everything leaning to the show just stopped. Blow every break, folks. Go.
This is an incredibly exciting project for what needs to be done. Now, it's going to be a long-term project. We're hopefully going to get started this year. We're going to have a number of years of construction, and so get ready for some disruption. But the end product is going to be fabulous. And so we view that as an equity role to actually orchestrate that project.
I had a 2.5-hour plane delay
Here we go.
JFK is BA-112. You had the Gulfstream. BA-112 is moving around. What are you going to do in the lessons learned from LaGuardia as a public-private consortium? Are you going to transfer that success over to JFK and do it in a timeline that's Rubenstein-like, or is it going to be Port Authority-like?
Well, I have to say, the lessons from the LaGuardia process have informed a lot of what we've done.
Yes.
And we're doing this in partnership with the Port Authority. And so we've had free access to planning, time schedules, a really collaborative approach, and we think that that will result in, yes, a giant project where there will be moments where everybody will be a little bit disrupted, but we think long-term this can actually be quite a smooth project.
This is about adding value to the economy.
Yes.
Some politicians in Washington that don't like what you guys do. What's your message back to them? It's election season. You're the football again.
Yes.
What do you say back?
It is election season. And so it's election season, and I think part of what happens during election season is people may not be fully informed by the economic value that our industry and Carlyle actually provides. And so what we're trying to do is really help inform everyone on projects like JFK. 5,000 new jobs.
But the challenge
in New York.
Glenn, this is so important. The challenge there is a labor construct in New Jersey, New York, and for all of you worldwide, we're going local here, but it's an American issue. The labor structure crushes you. To build a mile of road is a cliche. How are you, within a public-private consortium, going to solve what seems to be an intractable labor issue in building what everybody agrees are good things?
Partner with them. So in our equity...
You're giving the unions an equity kicker here.
Equity is the unions are investing in the project. They're actually writing a check to invest in the project and are really excited about the project and the return
We're going to
potential.
run out of time. I want to go here. What have you learned best practice from Heathrow other than their killer taxes they charge me?
Well, I was going to advance order and planning. So the supply chain for materials and construction phasing is critical. And you have to do it way in advance.
Can you get it so I can get a luggage card at JFK? I don't have to pay $8.75.
People come on. You. Tom makes it about him.
Ferro's got the little cute modern thing. I'm traveling with Mrs. Keene with 8 pieces of luggage. JFK's the worst airport in the world.
You know the history of these airports are? The airlines had to go out and build their own terminals.
Yeah.
So the whole airport is completely segregated.
So the key here is it's going to be much, much better. But this is a great example.
We're all doing this. We're all crossing our fingers.
I know. But this is a great example of, I think, the distinct role that Carlyle takes, which is how can we, in fact, add value? And that's in this investment environment where everything's expensive. I'll go back to where we started. Everything's expensive. This is what we have to do.
On Bloomberg Radio and Bloomberg Television, it's time that I get depressed. What's the end date on this project? Am I going to be around?
You'll be around. You'll be around. It's roughly a 5-year construction schedule,
oh, come on!
And the Terminal 1 will continue to operate while we're doing construction.
We're going to hold you to that.
Terminal 1 is the worst.
Years.
Larry Summers once went apoplectic in Dubai over Terminal 1 at JFK.
Glenn, we're going to leave it there. It's been great to catch up.
This has been wonderful.
Thank you very much.
Co-CEO.